Hello, everybody, and welcome back to our first episode for 2026 of the Property Investment Australia podcast. I am one of your hosts, Lachlan, Vidler, and I'm joined, as always, by my good friend, William Sanchez. Will, Happy New Year, my friend. Happy New Year.
Happy New Year. 2026 is here.
It is. And I know we did an episode that came out on New Year's Eve, so really we've taken it as long as possible to really give each other the Happy New Year.
That's right.
It's not really a greeting, is it? Though I guess the statement, the well wishes, all the rest.
Yeah, but it's better. It's better than to start. Yeah, it's busy. We're all busy. That's
Absolutely,
a given,
mate. 100%. Well, mate, I reckon we jump straight into this. I know that we're both so excited. We've got so much energy for 2026. So I think that we jump straight into this episode, which I think is going to be a really good one. I mean, not that I ever think we come up with a bad episode, but I think this one especially will be a really good one.
Biased there.
And it's what 2020, what the 2026 property market might look like and what we're watching. I think that that's going to be a really, really good, I think we're going to cover a lot of really, really good ground here. And I want to make it clear to people, this is not going to be an episode about predictions, right? We're not going to be sitting here and predicting, 10% in this market and a crash here and a crash there. What we're really going to be going through today, and when Will and I were talking about it, he said he feels like he's going to be a bit of a passenger in this conversation because he just wants to listen into especially some of my thoughts around it. But we're really going to be talking about what are some of the big trends and issues that we think that we're going to be seing in 2026 so that we're calling it out straight away. And it gives, everyone listening in, it gives you guys the chance to be ahead of the curve when it comes to that. So, Will, how are you feeling about this episode? You ready?
I'm feeling great. I'm just stretching my ears because I'm gonna be the passenger. I usually like to be the pilot, but I'm gonna be the passenger here. No problems at all.
I'm sure that at some point growing up, your mother would have said to you, you have two ears and one mouth for a reason. And I guess today...
Oh, absolutely. Yeah. You use that the same proportion.
Use it. Oh, well, let's get into it then. So coming through, I think that when we look back at 2025, there was a lot that really went on, and I think that a lot of the things that did happen, we might not have necessarily been able to predict it. I think a few of the highlights for me is obviously that we saw some interest rate cuts. That one's probably a little bit more predictable than other ones. We saw, continued government intervention, whether it's pro or con is probably not really, I don't really want to, I guess, give my 2 cents on that. But, we've seen continued tenancy reform around the country. We saw places like Queensland made some big adjustments to their contracts. They also made big adjustments to things like rent. We saw the introduction of the federal first home buyer scheme, or not the introduction of it, but I guess the adjustment of it that was meant to happen for 2026, but they brought it forward. We saw lending changes with some of the banks completely getting out of things like trust lending, and a big part of that was, people inappropriately speaking about it on social media and things like that. And then we just also saw property market performance. We saw markets go in and out of being smart to be investing in, and all around, I think we just saw really, really tight conditions that continue to be driven by affordability. How would you say that was for a bit of a wrap up of?
It was pretty good, man. I think you came well prepared for the episode.
Well, I try very hard, but it doesn't always pan out that way. But
Mr. Budget Battler.
It's the budget battler. Yeah, it's the time battler. So today, I think we're going to talk through, and I might be doing a little bit more of the talking than Will, but I'm going to talk through, I think, 4 really key trends or issues that I think that we're going to see moving into 2026, right? I think that that's really what we're going to be seeing, right? So for me, where I want to start with this is sort of rate movements and affordability uncertainty. So 2025 was interesting, right? We saw some rate cuts, and as we got to the back of the year, we saw some really interesting economic data starting to come out. So much so that at the last meeting for the RBA for the year, the RBA governor came out and said that now rate hikes are actually potentially on the table for 2026. What did you think when you first hoard? I can't even speak properly. What did you first think when you heard that, Will, that rate hikes might potentially be on the table?
Oh, mate, it's very hard, and it's very hard to agree with that, but it's disheartening at the
Disheartening.
same time.
Disheartening.
Yeah,
Yeah.
but yeah. Well, what do you do? What do you
What do you
do?
do?
I don't think that's gonna happen, but
Yep.
who am I to say otherwise?
Well, you are William Sanchez, platinum broker. That's who you are.
Oh, my guts will always tell me, and I
Yeah.
will always go with my guts. Believe me, that's
Yeah.
number one.
Yeah.
But yeah, if they're saying that's going to happen, well, this year they said that we're about to experience so many rate reductions,
Mm.
which we are yet to see. But
Yeah.
anyway,
Well, I guess from my perspective, it's really interesting, isn't it? And I actually, I'll go out on a limb and say I do not envy the RBA and their position in this, because what's really happened is that inflation has proved to be really tricky. That's really the big issue that we're seeing, and that's stemmed by a few other things. But as we got to the back of 2025, we saw that inflation actually ended up being quite sticky. And that's without even including certain things like, the government's been handing, the federal government's been handing out an energy rebate for a little bit of time. And that's helped to keep inflation lower, because that rebate has had, I guess, a perceived impact of not paying more effectively, or not really paying more. But now that that's going to go away, or they said the most recent aspect that I saw, which was in, I think, December, that they're not going to be renewing that energy rebate, which means that we're going to see a bit of a chunk up from that. We're still seeing that employment is pretty sticky. We're seeing the employment rate isn't necessarily rising too much. We are seeing certain things around underemployment, underutilization. We are seeing things around job growth or reduction. It's a really mixed kettle of fish going on, right? But then we're seeing that people are spending money, and people don't tend to spend money if they don't have money. So it says that there's a bit of pent up sort of demand in the economy still there. And obviously we've had the rate cuts, so there's a lot going on. Then we've seen, in December, the Fed over in the US, the Fed cut rates, which can at times have a bit of a disinflationary impact on us too. So I guess the long and the short of it, without getting too technical, is we're a bit all over the shop. And I think that moving into 2026, it's going to be somewhere to watch. I think that a lot of bank economists, or just economists in general, are quite split. I think that the majority are still falling into the camp that they don't believe that there's going to be a hike. But I think that a lot of them also don't believe there's going to be a cut. So we're in a really interesting position. And I think that what we now need to call out is whatever happens, happens. And people don't need to throw the baby out with the bathwater, right? Like we saw when we had all the interest rate increases, all the interest rate increases that happened a few years ago, right? We were seeing month after month, hike after hike. The property market still performed pretty well. So I want to call that out, right? Whatever's going to happen is going to happen. And, you can't control that, for everyone that's listening, and you yourself cannot control that. So it's important to really remember that whether we have a cut, whether we have a hike, or whether we stay still, it's going to be something to watch for next year. And I can promise you that what's impacting the housing market right now is not really going to be changed that much by a 25 basis point increase in interest rates, right? Even a half, right? Like we've seen a few rate cuts, even if it went back up to where it was. The issues that are facing the property market are a lot more structural than some adjustments in the interest rate. So I want people to remember that, right? I really want you to remember that as we go forward. And I think that as well, we need to see affordability in a different light as well, right? Like whilst there might be some pent up demand, my personal belief is that is being fueled by a lot of Instagram and social media, and people seeing people buying expensive things and all the rest. And yet people are still living on a bit of a knife edge of affordability.
Yeah, I was
What do you think,
gonna ask you a question. Your
Yeah.
personal thought end belief, because I didn't want to start, talking about the American interest rate cut.
Yeah.
But historically, when you see that, what do you see happening in Australia not long after?
What, cuts? Is that where you're going? Yeah.
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 So
Traditionally,
it's
yes.
weird. It's weird to think like there's going to be some rate hikes in the near future. To be very honest with you, but
And
it's a bit of a mixed bag at the moment, because if you look at the world, what's happening, across different oceans, if you will, but there's lots of variables going on, right? And each one is trying to sort of play with the cards they're dealt with.
And that really is the issue at play, is that, like, America's often acted as a global proxy for the economic environment, but we do see some structural issues that are going over there, and structural economic issues that are going on over there, and it's not about politics or anything like that. It's just about the fact of the way markets and the economy can perceive certain things, and the way the world obviously reacts as well. So it's my personal opinion is it's a tough spot to be in, right? And I think if I loop that back then into the affordability side, like, affordability is a big issue. Like I said, I don't think people aren't sitting there and eating caviar with breakfast. Like, a lot of people are still struggling. I think it's just that a lot of people are potentially making fiscally poor decisions because there's images that are trying to be conveyed, and perceptions and things like that. So when we talk back about affordability, right, like, property market affordability is also a big driver of that, right? Like, it's something that is not, it's something that cannot be overlooked, right? Like, at the end of the day, are a lot of people going to be able to afford a property if we see that around the country median pricing starts to hit towards $800-900 $1 million, right? And sorry, I probably shouldn't say median pricing around the country because it gets skewed, but if we start talking about, like, Sydney's obviously an expensive place, right? Brisbane, Melbourne are also quite expensive places. But when we start to see, like, the big regionals, like, when we start to see big regionals where, like, they're maybe starting to gust towards, $800-900 $1 million as a median price, like, it's going to start to have impacts, and people are going to have to start moving and things like that. And I'm not saying it's necessarily a 2026 only issue, but that affordability side is something that people, should not lose sight of, and the fact that I see a lot of those more affordable markets are going to continue to increase in price, and it might not necessarily be because anything in that market is happening significantly, but just as a pure outcome of the fact that people can't afford to be either buying or investing in other markets. Like, that's what I see. If you've got a regional market that's not too bad and it's priced at $550, like, when other markets are priced at $850, people are going to look there, either to move or to invest. It's just, it's naturally what's going to happen. What are your sort of thoughts on that, Will?
No, I couldn't agree more, man. I couldn't agree more. I've spent the last couple of months in Brazil, and closer to America. I've seen firsthand what's going on over here, and let me tell you, it's just crazy to see the difference. How much difference to the Australian market in terms of price entry levels.
Yeah.
Right. You can buy a property in Brazil for, like, a unit for 250,000, like a 3-bedroom unit.
Yeah, wow.
A nice one, which is in the Brazilian currency. Like, it's just beyond imagination when you look at what you can get in Australia. Like, it's just beyond belief.
Yeah.
And if things keep going like that, you hit the nail on the head if you think about it. Like, where is it going? Like, how much do you need to earn to be able to buy, to be able to afford a property?
100%. 100%. Well, let's go on to our second trend, or second topic to be on the lookout for, right? And that's the continued supply and demand imbalance, and as an impact of that, the structural shortages that go along with it. So, I think that this really links back into that whole idea that if rates were to go up, this is where we're really sitting, right? And that is that we are still very firmly sitting in this housing crisis, right? Very firmly, right? The government brought out their housing accords. I think I've talked about it on this episode, right? and still not meeting it. Like we've had the first, the first crack at really getting it done, and we're behind. Like we are not anywhere close to where we need to be. I think it was around 170,000 homes short after 12 months of where we needed to be. And it's, it's so tough. Like it's just, don't quote me on that 170. I'm just trying to think through what it was in my head. It might not have been 170 short. Whatever it was short, I've talked about so much on different podcasts. The point is that we were trying to make record-setting construction numbers with just the amount required each year, so the 1.2 million divided by 5, and yet in the first year, I think maybe it was actually we did 170 because it's 240 a year. Maybe it was we built 170,000, not 170,000 short, which would make sense, right? The 240,000 would be up there with record breaking, if not record breaking, and yet we couldn't even hit that in year 1, which means in year 2, not only do we have to hit a record to be on track, but we've got to go more to then account. So like these are real structural issues, and that's why we are seeing so much of what it is that we're seeing, right? And there might be some markets that are building, right? It's not that every market that needs property isn't building, but it's that across Australia as a whole, it is not being developed fast enough, right? And then that is being compounded out by the gap that we're seeing in, overall population growth, where yes, there is an element that's driven by migration, but still just broadly around population growth. And the fact that we have the shortage for the existing population, let alone the growth in population that we see, right? So that is having an impact, because at the end of the day, if in 2025 there's 10 people looking to buy a home, in 2026 there's now 12, right? Or whatever that number is. And those extra 2 add the competition, and that competition is the demand side, and the supply side is not meaningfully moving. So naturally, it means that prices are moving, and we are going to continue to see that for 2026. Like there is no doubt in my mind about that. And I guess I loop that back into that affordability piece I was talking about on the first trend, because that's that is a huge marker for where we're going to be going to, like a huge marker. And I really see it that, like, I'm going to call it out. Like, I see a situation, I don't know what the time frame is, certainly not 2026, but $1 million is going to become the standard house price. Like, that's where it's going to go to. And
we're not so far away, my friend.
Right? Like, and like, that's in regionals, that's in capital. Like, it's going to be $1 million as your baseline. And I mean, it. You do all the mortgages. Like,
well, let me tell you a bit of give you a bit of an example. I think I did not long ago, we did a 2-bedroom unit in front of Sydney Park.
Yeah.
There's a big complex there. I think it went for like 1.4. Like a 2-bedroom unit, 1.3, 1.4. Like, how does that make sense?
You think that's not even a house either. Like, we're talking about a unit, It's
unbelievable. That's all I say.
Well, I really see it as we are heading the direction of, your New Yorks, your Londons, your Hong Kongs, like, and a big issue in Australia is that we have the largest houses by land size in the world. I'm pretty sure, I'm very certain that's the case, right? And that's great, but the reality is that then becomes expensive because, you can't do it. Like, you go somewhere like Bondi in Sydney, you can't buy a house for less than probably 5-6 mil now, right? And that 5-6 mil is going to be, that's a house, that's a 3-bedder, and it needs work. What?
I remember when I arrived in Australia, the trend among the wogs, do you know what it was? Let's rent a property for like a night in Bondi, just for fun, just for the weekend. Like, you spend
just
$3 grand.
Just to feel like you're part of it.
Yeah, it was funny. Yeah.
Right. But that's where that is where we're going to, and it really is underpinned by this real, supply and demand imbalance. It is a structural issue now. It's not just we've had a bad year or two. It is a structural issue, right? So for me, that's probably the second trend we're going to continue to see, right? The third trend is going to be around rental pressures and yields, right? So for exactly what I was just talking about in terms of the property growth side of it, the rental side is also a really, really big issue, right? And we're seeing things as well where governments are making policies that are being very pro-tenant. And I've said it before, it's not that I think that there wasn't room to increase tenancy protections and things like that. I think that that's fine. It was there and there was that space. But some of them have definitely gone quite far, right? And some of them are only going to continue to go further, right? And what that means is the government has basically does not want to be the landlord, right? So now the mum and dad investors are the landlords, right? They're the landlords for the country. And yet we're now seeing policies coming out that are making it very prohibitive for them to do it, right? We saw things around capital gains in super. We're seeing things around negative gearing all the time. We're seeing things around CGT all the time, right? Like talk, I mean. So this continued rental pressure is a really big issue because rental affordability is another big crisis that we're facing. And I guess that's the thing to remember is we're not just talking about buying properties, we're talking about renting them too. So, we're seeing that rents are increasing massively, and it's only really going to continue to do that, right? It's going to continue to do that. We're seeing that yield compression where, investors are having to be willing to accept less yield everywhere. Like at the start of 25, a lot of markets, like I'd say, markets like a Perth, right? You could jag a 4.8 to 5% yield, right? In certain pockets of like the Perth markets and stuff. Now you're talking like low fours, right? You've had probably a good 0.5% yield compression. A lot of the regionals, big regionals, of course, never talk about the small regionals. A lot of them you could find a 5, right? Very high 4 or a 5. Now, 4.5. Some of them, low 4s, right? Like some of those regionals have really exploded so much where the growth has outstripped such a huge amount that some of them are now sitting around like a 4.2, 4.3% yield, right? Like the same sort of yield that you'd be getting somewhere like a Perth market, right? Or a Melbourne market, right? Melbourne, a bit tough, definitely not Sydney. Maybe a Brisbane, but still a bit tough there. But like you were talking about that some of the massive regionals are now on par with this yield compression to some of the capitals, right? Because we have such a structural shortage going on and such a pressure on house prices that it is outstripping the rental pressures by so much, right? But what we're also seeing is that investors have to be getting comfortable with the fact that they are going to be taking on less yield, right? That is just a fact that people have to get comfortable with. And I think as well, investors are going to have to get comfortable with the fact that when you're looking at markets to be investing in, yes, there is rental pressure, but when you're looking at who's renting, you want to be getting people in. You want to be getting people in. You want to be getting them at a good rent, because if your yields are already compressed and you then start to have, millions of requirements on the tenants, you're going to reduce that pool. And even though there is a shortage, you need to be careful. Like I was hearing about from a property manager that we work with of one of our clients. They set some very interesting requirements, right? They said no single people. They said no couples. They said it had to be a family with kids. They said they couldn't be people that worked like blue collar type jobs. Like they wanted white collar only, like professional type jobs. And then the client came and sort of asked a question to us of like, oh, the PM's really struggling to get some tenants in. And we had to say to them, like, that's because you've set some really unrealistic requirements. Like there are heaps of people out there in that market, but you kind of got to balance that a little bit, right? So, that's my thought there. What are you sort of seeing? Because, you see the rentals on mortgage applications. Have you got any thoughts around that?
Oh, exactly what you said, man. Like I said in the previous episodes, I think every single application would do, we've seen the rents sort of be more conservative.
Yeah.
And that's the guidelines set by the banks as well. They're saying, guys, there's no point, going for high rent and returns here if they're going to be unrealistic. Because at the end of the day, we're going to have to sort of block it. And if they don't end up getting those returns, chances are we'll have to decline the application because we just simply won't get them. And it is across the board as well. It's not just here and there. It's across the board.
Well, I think that the flip side of that as well is that like, if I could, making two more points on that. First one is around the tenants. Is on the flip side, don't accept anybody because you're just trying to get your cash flow as high as possible either, because that's going to be a bigger issue. Like, taking an application that maybe doesn't look very good for whatever reason that is, or take an application $10 or $15 lower from somebody who's a really good at strong applicant, you've also got to keep that in balance. I think that's something really important going into 26 that people remember is don't, yields are compressing. So don't then make a bigger issue by taking on a bad tenant either. You got to remember that.
Yeah, but then what?
Yeah. Yeah, go on.
But the key point is there?
What?
To have a solid property manager who will put you in your place.
Yeah. Oh, 100%. Take their advice. Exactly right. Like they are the experts, and ask them, because the thing is you got to remember is if you go to them and say, I just want to maximize my rent, they're going to put forward applications that might not be the best because that's what you said. But like when you go into them and you're saying, where's the rent sit? Obviously, we want to try and maximize it. Like what sorts of people do you think we're going to get, or what profiles of employment and things like that? Okay, cool. That's that. You got to take it all into account. Take their advice. That's an awesome point. That's an awesome point, right? The last thing I want to say on this third trend around rental pressure is the other side of it as well is people need to be comfortable with the fact that there is less yield getting around, right? Don't go and sacrifice your property strategy to hunt a little bit of extra yield, right? We're already seeing conversations like this where people are going like, oh, they're trying to focus on either the wrong property types or the wrong markets, or they're being unrealistic about buying good properties because rental yields have compressed. People looking for the unicorns, right? I want a 5% rental yield. I only want to pay $600,000 or something like that, $700,000. It doesn't exist, right? Or I don't know, sorry, I'm not going to say it doesn't exist, right? But that is like a real unicorn, right? You need to get comfortable with the fact that rental yields have compressed and that good assets, there's a difference between rental yields have compressed compared to going into Sydney and buying a property that's got a 2 or 3% rental yield, right? Like there's a difference between them, right? If you're a little bit negative, you're losing, maybe $1,000 extra a year or something, you're $1,000 a year negative or whatever, but you've bought a good quality asset that is still at a market leading rent or yield. That is still good, right? Like you got to remember that if yields used to be 5%, but now they're more in a good investable markets around 4.5, everybody's dealing with the same issue as you, like you got to keep that in perspective as well, right? So that's, I guess, the last point I'll throw out on that one, right? Now, the final one I want to talk about is about smart and scalable portfolios, not mega portfolios. So we see it all over social media. It's easy to go and brag about having a 20 property portfolio when you started 10 or 15 years ago, right? When lending was in a really great position. When your interest-only loan was only assessed off your actual repayments, not about what would happen when you went to P&I. When you had other things at your disposal, and banks didn't really care about serviceability tests as much as, they do today, right? So where I'm going with this is that you don't need 10 or 20 properties to build a strong portfolio or that's going to set you up for a really, really strong retirement. You don't need that many, right? Now, obviously, of course, depends on what your goals are and all the rest. But I mean, for the average punter, the average mum and dad investor, you don't need 10 or 20, right? A good 3 to 5 to 6 type properties, especially built over the long term in good areas that make sense, that fit your portfolio plan, that can be enough to set you up for an amazing retirement, especially when you then go and take into account things like your superannuation, your other savings, all the rest, right? So I think in 2026, especially because we're dealing with affordability issues, prices that continue to move, yield constraints, all the rest, is remembering you don't need a mega portfolio, right? You also don't probably want the hassle of it either, right? Like it's a lot of work to deal with that, right?
Absolutely.
Focusing down. Like how many people do you see really, Will, that actually have 10 or more properties? I'd say it's very few, right?
No, it's you can count and you can get in,
one hand each year. Yeah. Right.
Yeah.
And that's because even though you might see it on social media, it's not the reality, right? The stats tell us that, right? Like 90% of investors only own 1 or 2, right? And you need more than 1 or 2 to be able to set yourself up. So that's why you don't want to fall into that category. But if you're around the 5 or 6 mark or the 4 to 6 mark, right? And especially if you built that over 10 years, right? That's a lot more achievable than people think. And that really sets you up, right? Like you think if you bought, let's say $2.5 million worth of assets, right? Like what's that? Like, hang on, I'll do the maths really quickly here. Like let's say you bought 5 properties worth approximately 650,000, that's 3.25 mil, right? And let's say you bought that roughly over 10 years. So let's say that after 20 years, the portfolio has doubled and a bit, 1.5 times, because you've had it for 10 years and some you bought earlier in that 10 years, right? So if we 1.5 that, right? You're talking about at the 20-year mark, you might have an $8 million portfolio. And if off that 3.25, let's just say you leveraged up, but you didn't really, like when you bought it, like let's say you bought it 85%, right? You had, let's just say it was 2.75 mil of debt. You got an 8 and a whatever portfolio I just said. You got probably like an $8 million portfolio against 2.75 mil of debt. Of course, we're not taking into account inflation and all the rest.
It's a good result, isn't it?
Right. You could probably, if you really wanted to, you could probably go and sell that entire portfolio, clear out the debt, of which that 2.75 is in today's dollars, roughly today's dollars, right? You think when you take into account inflation, that inflation is probably only worth the equivalent of like, 2 mil today, if not less. But you go clear that all out,
Yep.
You're probably pocketing in net terms today, $2 to $2.5 million that you could put in the bank account in terms of purchasing power today, right? If not more, by the time you pay your taxes and all the rest, might even be more, right? Might be 3 mil, right? You add in super, you do all the rest. You can see how you don't need a mega portfolio, right? So I think that the fourth trend that we're really going to be seeing and really harping on about, and it's going to be a function of the fact that affordability is a huge issue for it, is smart and scalable, not mega. What do you think about that?
I love that. Love
it?
that.
You love
No,
that?
absolutely, man. Yeah.
Perfect, mate. Well, that's the 4 trends, right? First one, the rate movements and affordability uncertainty. The second trend, that supply and demand imbalance, is really leading to the structural shortages. The third being that real continued rental pressure and yield compression. And then fourth, being smart and scalable portfolios, and that you don't need a mega portfolio, let alone it's going to be hard to get there. That's our 4 trends for you guys on this episode. So before we wrap up, I want to give a huge shout out, right? We're back. We're raring to go for 2026, but go back and have a listen to our last few episodes where we've really talked about how to kick off your 2026 in a smart way and to drive forward, and what that opportunity cost was for people in 2025 that did not take action, right? What was that price of waiting? If you haven't listened, go back and listen to them, because now we need you to start taking action, right? We need you to start taking action. So to do that, come have a chat with myself and the team at Atlas Property Group, right? atlaspropertygroup.com.au. Fill in your details. We want to have a chat with you. We want to get you moving. We want to get you in front of some of these trends and manage that for you, right? And then on the finance front, go and hit up Will and team at Aussie Newtown. Their details are in the episode and show bios. They want to help you out on the finance, and we need to get it done for you because it's only going to get harder as this year goes on, all right? So guys, we'll leave it there. We're so happy to be back for 2026, and we can't wait to be with you for the next episode.
This is a Piccolo podcast production.